produces a government deficit as percent of GDP under every president since 1900. Here you have Trump, here you have Biden. Outside of World War I and World War II, essentially, the Trump-Biden level of deficit spending is off the charts. Really bodes very poorly about what the future prospects hold in terms of the ability for fiscal situations to continue to artificially, in our opinion, power the economy and markets and things like that. Hello, everyone. This is John Llodra. I'm a founder and partner here at New Harbor Financial Group for our weekly market commentary. We like to bring data, insight to our viewers, and really for the purpose of educating and informing them and empowering them to make better financial decisions and hopefully live a little bit more stress-free lives when it comes to financial matters. I'm going to wade into some dangerous territory, I think, this week, and it's really about the political environment and the upcoming presidential election in November. Here we are on Tuesday, July 2nd, 2024, just a small number of days away from the first presidential debate between President Biden and former President Trump. And by almost everybody's assessment, the debate was shocking, halting, some consider a disaster. And depending on what political party one is registered or associates with, maybe they saw parts of brightness or optimism or promise, and others saw really a shocking and rather troublesome picture of the state of affairs when it comes to our upcoming presidential election. I want to be very clear. My intent here is not to take any political sides. Just for full disclosure, not that this matters, because this video is really about the market and the economy and what we think it translates to in terms of the investment landscape currently and ahead. But for full disclosure, I am decidedly and wholeheartely an independent voter. I share the view that perhaps many view that I think both parties and the leadership of both parties have gotten into a precarious situation from a fiscal and monetary situation that has built up over many years. This is not a new development, and we think it has profound implications for the market we're in and we're likely to see. So I want to be very clear, this is not a political video. It's meant to just share some perspective about the likely investing landscape in light of the realities that we face right now. So let's start with the recent debate. I'm going to share a slide here that was put together by Jim Bianco, who we think is a fabulous analyst. And if you don't follow his work, please do so. This shows, going back to July of 2023, the average of various betting sites, if you will, for the odds of a Trump or Biden victory. Trump's odds are in red, and Biden's are in blue. Now, to be very clear, these aren't polls. There certainly are various polls out there that will talk about odds of either candidate winning, but these are the betting markets, and they sometimes can be very predictive and useful, and sometimes there's some noise. But take this for what it is. I think the most notable thing I want to point here, obviously there have been some spikes and declines over the course of the last year or so, but I want to focus on right here. This is essentially, as the debate was being aired live, we saw a dramatic drop in the odds of Biden's likelihood of victory from almost 36% to down about 19-20%. And Trump's odds spiked very quickly here up to about 54%. Again, this is betting sites. It's not a poll. This was the reaction to what many folks felt was an arresting situation with Biden's demeanor and capability during the debate. Obviously a lot of concern. Let's talk about the market reaction. Interestingly, most asset classes, most types of investments have had a very muted reaction to the debate. The one asset class that is the exception and had a rather remarkable reaction is the bond market, U.S. Treasury bond market. So this is a chart going back over the last year of TLT. It's an ETF that holds 20+ year U.S. Treasury bonds. And you can see here, this is the day after the debate. Pretty major sell-off that's followed through the last couple of days here. And interestingly, this is on Friday, the 28th of June. This is a day we actually got a fairly favorable, or at least not unfavorable inflation report in the form of the PCE, which is the Fed's preferred indicator. So that taken alone, you would have expected that Treasury bonds would have rallied. In fact, they did spike higher a little bit in the pre-market anyways when that release came out. but very quickly that was reversed in a very abrupt fashion. And it's very hard to pinpoint what the cause is, but the general consensus is that this was a market reaction to the turmoil that has entered the US presidential race. Obviously, all kinds of speculation about what's going to happen. Is Biden going to step down? Is he going to be forced out? What does this mean in terms of election results? Of course, there's a whole different realm of uncertainty regarding the Trump campaign and his status with legal battles and recent Supreme Court rulings on levels of immunity. So generally across the board, without picking sides, there is an environment of uncertainty and turmoil. And generally speaking, bond markets especially don't like turmoil when it comes to national politics. Just over the weekend, the BIS, which is the Bank of International Settlements, it's kind of proverbially known as the central bank to central banks. They came out with their, I think it was an annual report. And in that, they highlighted one key area of risk that they see is instability in government and government bond markets as a result of that. And, we can look at many, many examples of that over history, but let's look at a recent example in France. There's some pretty dramatic political turmoil and events unfolding in France with Macron's party and the challenging populist party Le Pen. And I just want to show you kind of how dramatically the French bond market has responded to that. So this is a chart that shows over the last 6 months how the French yield curve has risen pretty dramatically. So this is along on the x-axis here is the different maturities. And then here on the y-axis is the interest rate. So back 6 months ago, this is what the yield curve looked like. 3 months ago, yields had spiked up dramatically from this dotted yellow line to the dotted green line. And then just in the last month, they've shot up even further. This is against the backdrop of pretty dramatic political turmoil. So remains to be seen how much this continues to affect U.S. Treasury bond markets. We have a very modest allocation to longer-term Treasury bonds. We are certainly watching that very closely and likely to take some hedging type protections in the near term if this volatility continues to play out. So backing away from the recent turmoil of the debate, let's take a step back into what we're likely to see over the coming months. There are all kinds of articles, messaging, maybe even propaganda about what party has historically been good for markets in the economy. And there's a lot of data out there that is a bit misleading. So I'd like to share an article as just one example of the kinds of things we might likely see coming over the news over the next several months as the election gets closer. This article goes back to 2016. And the headline is very eye-catching. It says, this is obviously in advance of the 2016 election. It says, Republican presidents rule recessions. And it goes on, this article, to talk about how essentially recessions and Republicans seem to go hand in hand. And it also talks about how different measures of economic activity on average under Democrats tends to be more favorable than under Republicans. And it throws out some data here. This article references a study that was done by a couple Princeton professors. And I'm going to pivot to that because ultimately what the studies have found is that a lot of the results for certain economic or market activities under given administrations or party rules can be chalked up to somewhat random good luck. And really the things that kind of really affect the economy and markets are bigger picture policy and economic situations like debt and deficits and inflation and things like that. And these things tend to have a much longer lead and lag time than a presidential term or even terms. These things oftentimes are many, many years, if not decades, in the brewing. And of course, presidential tenure is no more than 8 years. So oftentimes there's a bit of overfitting, if you will, to a president and what the economic and market landscape has done. So again, here is the paper that was done, the research that was done in 2013 by these professors at Princeton. I'm going to jump to the conclusion page. So conclusions. But the key point here is it seems we must look instead to several variables that are mostly good luck. Specifically, Democratic presidents have experienced on average better oil shocks than Republicans, a better legacy of productivity shocks, and more optimistic consumer expectations as measured by the Michigan ICE. We look at the economic and market landscape, and I want to share some some slides that kind of paint a picture in that regard. So here's a slide that speaks to one of those luck factors that research just spoke to. This is the University of Michigan Consumer Sentiment Indicator. Here we are right now. Now, a couple of things I want to call out. We have had a very sharp decline here. Usually when there's sharp declines like that, or very often when there's sharp declines like that, it coincides with the onset of a recession. I want to point out that in this economy right now, where unemployment is low, markets are near all-time highs, and people generally feel like things are okay, at least some part of the economy. There's a bifurcated economy out there where many people feel left behind. But we are at levels that right now are even lower than the lowest low of the COVID shock back in 2020. So this speaks to a very poor consumer sentiment backdrop. Not generally a pretty good thing, a good sign about the likely path ahead. This next chart is the results of a survey that was done back in May. And I think this speaks as a referendum to what likely is going to rule how the election plays out over the next several months and leading into the actual election in November. So these are the things that top consumers' concerns. Inflation is a major factor. Interest rates, higher interest rates that have cost of borrowing to go way up. Housing prices. These are all structural things that are not easy to turn around in a very quick period of time. Interestingly, we're starting to see jobs start to become a concern. Even though we have very low headline unemployment rates, people are becoming more and more concerned. Now, interestingly, the concerns about recession and stock market are pretty low here on a relative basis. And I would almost contend that these maybe are contrarian sentiment indicators. Typically, when markets are at all-time highs, people don't feel worried about it. And when they're at lows that are great times to be buying, they are worried about. So these, I think, are probably contrarian worrisome indicators. But anyways, these are the factors that will likely play out and drive the markets and economies for months and years to come, frankly. This is another factor leading into perhaps what is also tied into the consumer sentiment. This shows the aggregate excess savings of households coming following the onset of a recession. So it looks at all these different starting recession points, 70, 73, 80, 90, 2001, 2008, and 2020. Now, in almost every prior instance, the onset of recession saw an increase, or at least not a decline in the excess savings rate. The real anomaly here, which we think has driven the markets and the economy over the last few years to very unhealthy levels, is all the stimulus that was put out during COVID really padded the pocketbooks of consumers. But then it's been a vast and really sharp drawdown, so that all those excess savings have now been spent. So the consumer is running on empty, I think is safe to say. And overlay this with data points showing an uptick in credit card delinquencies and things like that, it really paints a picture that we may be running out of gas here, so to speak. One of the big debate topics is going to be deficit spending. Clearly, it's in the headlines that certainly in the wake of COVID and over the last couple of years, there's been a huge amount of deficit and debt binging in Washington. I think in the debate the other night, President Trump talked about that and made the claim that deficits weren't that bad under his administration. And as you can see, since the 70s, this has started to accelerate rather dramatically and has gone parabolic in a very real sense. Probably not coincidentally, this is when the U.S. finally got off the gold standard completely in the early 70s. And it's probably no coincidence, we certainly don't think it is that we have gone on a fiscal spending binge ever since. And that has only become more exacerbated and more apparent in this graph. And this covers both Republican and Democratic administrations. So both parties have been guilty of spending. This next chart really paints, I think, a dramatic picture. This is a government deficit as percent of GDP under every president since 1900. Here you have Trump, here you have Biden. Outside of World War I and World War II, essentially, the Trump-Biden level of deficit spending is off the charts. Really bodes very poorly about what the future prospects hold in terms of the ability for fiscal situations to continue to artificially, in our opinion, power the economy and markets and things like that. Aside from the fiscal environment, a huge impact is the monetary environment. Look, in response to the great financial crisis, the Federal Reserve and their brethren across the world undertook the most dramatic and range of experimental monetary policies the world has ever seen. And it involved literally printing trillions of dollars out of thin air, using that to buy debt and drive interest rates artificially low. And we think that, and the data bears it out, that asset prices of all manner, whether you're talking stocks, certain kinds of bonds, real estate, you name it, were bid up as a result to unnaturally high levels. Valuations in many cases that have only been seen a couple times in history. If you look at the stock market, for example, the S&P 500, if you impute back to the Great Depression, the only time we've seen valuations of where we are right now comparable to the S&P 500 is in 1928, right before the Great Depression, and 2000, right before the tech bubble collapse. We're even much more adverse valuations right now than we were in 2007, right before the Great Financial Crisis. So the question is, what does monetary policy have left in terms of being able to boost the economy or asset prices? We are in the midst of a pause in the Fed's hiking cycle that is just about a year. The last time they raised rates was back in July of 2023. So we're about a year of the federal funds target rate at 5.25% to 5.5% target range. Big question is, when will the Fed be able to start to cut rates? And that view has dramatically changed over the last half a year. End of last year, the Fed itself was signaling likely 3 cuts in 2024. The market actually way overestimated that. The market at one point was estimating 7 to 8 cuts. So here we are today, and the likelihood of even 1 cut is questionable. So the question is, even when the Fed starts to cut, what does it mean for markets? And if we go back in history, it's a pretty mixed signal as to what that means for markets. Let me share a paper that Charles Schwab had done. This goes back and looks at going back to 1929 through 2019, after the trading days before and after the first Fed rate hike. Basically, this shows, after the final rate hike, what happens to the market returns. On average, you can see it's been rather muted, plus or minus 1 to 2%. But the actual range over history has been pretty wide. The question is, what might likely hold this time around? Well, there's been some great work on this. John Hussman's done some great work, but the takeaway is when valuations are as extreme as they are now, you oftentimes will get a situation where rate cuts are actually accompanied by dramatic sell-offs in the stock market. This is a chart we shared some months ago, and I'm going to share it again right now. This goes back and looks at the major declines in the tech bubble and the housing bubble, and it shows that, so first of all, each of these red dots shows a rate hike. Each of the green dots shows a rate drop. And here's what the profile of the federal funds rate looked like overlaid on top of the S&P 500. Now, of course, we see this period of extended, essentially zero interest rates coming out of the great financial crisis. Then they started to raise in 2016 through 2018 and right back down to zero. What you notice here, despite these dramatic drops in interest rates in the 01, 02 and the 08, 09 periods, the market dropped even despite that. So the idea that the drop in interest rates is suddenly a guaranteed rescue by the Fed of markets just doesn't align with history. There are clearly a lot of big, complicated factors at play. And as tempting as it may be to want to simply say, well, if this party gets elected or this candidate gets elected, this is what it will mean for markets. It's simply quite not that simple. And in fact, many of the factors that we believe will drive markets are many years, if not a decade or more in the making, and really not tied to any one administration. If anything, it's both administrations together have both parties together have co-opted to create a really challenging situation from a fiscal and monetary policy standpoint. So we obviously will be watching things with close attention, and our main job is to protect and preserve our clients' assets, but we also want to, of course, grow those assets, help our clients grow those assets without taking undue risk. I want to thank you for watching. We'll be back next week with our take on things then. Have a great day.